let's shift focus and let's talk about what's happening within the cement pack because, a lot of pressure is getting added because of the war in West Asia. And let me welcome on board Ashutosh Murarka and get in his opinion on the cement sector in specific. Ashutosh, hi, morning. Good to have you on the show. Let's first talk about the input cost pressures and the kind of, hike that they are seeing and the pressures because of the war in West Asia, with petcoke, coal, and now even packaging costs rising quite sharply. Tell me, how severe would the current margin pressures be?
In this ongoing geopolitical tension situations, we are expecting power and fuel cost to inch up because while in cement manufacturing, nearby 30% of its cost is because of power and fuel cost, in which majority of cement companies are using 50-60% of the US petcoke in that cost. So we are expecting something around 150 to 200 per ton of total cost increase because of this war situation. Also because of freight expenses also going up, and this PP bags prices are also going up because of crude oil price increases. And to inch up with this cost, if companies wants to transfer this cost, we are expecting 4 to 5% of realization increase to be taken up by the companies.
Interesting. So also I wanted to talk about this LPG crunch and packaging cost spike as well, Ashutosh, because that's going to weigh in and have an added pressure, right? And from what we sense is that this 20% surge in packaging costs because of the LPG crisis is going to be quite significant in terms of how heavy it'll weigh in on the margins.
Yeah, this packaging cost will also weigh on EBITDA by something around 50-60 per ton as per our estimation. So we are expecting something around EBITDA will impacted overall by something around 200 to 250 per ton because of these war situations.
Okay. And how is pricing evolving, especially on the cement side of things, Ashutosh? If you can give us some color on that, and whether any specific geography is witnessing a spike at all, or are we expected to therefore change the pricing environment or change the pricing outlook when it comes to cement?
So if we look for pricing for Q4, pricing remains volatile in the quarter. However, companies have tried some of the price hikes of 15-20 rupees in the quarter, but majority of these price hikes have been rolled back because of oversupply of the capacity in the industry going forward. In April we are expecting some of 7-8 rupees of price hikes to come, but the subject comes for sustainability comes to the matter of demand and supply. In long run, cement industry is going to add 140-150 million ton of the capacity by FY28, and the current utilization of cement industry is something around 65-70%. So as per our expectation, if this utilization level increases to 75%, then we can expect some positive momentum into the pricing. Otherwise, prices are expected to remain gradual or to remain volatile. And if I talk about region wise, in north region price hikes has been sustained. In that region, there is 10-15 rupees of price hikes has been taken by the companies. South region remained weakest in the pricing because of its competitive nature, and in east region prices also been rolled back because of oversupply of the capacity.
Ashutosh, curious to know, because I have you here, is there a tilt or a preference currently within the cement pack that you're liking, or within the infra pack that you're liking at this point? How would you play those spaces?
In cement, we are liking Nuvoco Vistas and Ultratech Cement. Nuvoco Vistas is because its acquisition of Vadraj Cement, which will add 6 million ton of capacity in an untapped region, which will provide an additional volume benefits, and also it's better premium mix than other players. And also Ultratech because of its
Okay, Ashutosh.